I'll start investing when I earn more. I'll wait until my debt is gone. Sound familiar? Here's the truth. There's no perfect time to start building wealth. Investing can feel like a maze. Too many options, confusing jargon, and no clear place to start. It's easy to put it off because it seems so overwhelming, but here's the thing. Building wealth doesn't have to be complicated. In this video, I will show you a well-diversified portfolio specifically designed for growth and income. In the end, I will show you how you can use this portfolio to turn a $75 a week investment into over $1 million portfolio, and even better, pay over $100,000 in annual dividends. So why aim for a $1 million portfolio? What's the big deal about a $1 million portfolio? The answer is simple. Having a portfolio like this means retiring comfortably, supporting your loved ones, and never having to stress over unexpected expenses. Retirement isn't getting any cheaper. With inflation and increasing healthcare costs, hitting the $1 million mark isn't a luxury, it's a necessity. The good thing is that you don't need to start with a lot. In fact, you can start with only $75 a week. You might be questioning, $75 a week? Is that really enough to build a $1 million portfolio? The short answer is yes. But it's not about the amount you invest every week. It's about being consistent and letting compounding do its thing over time. Let's break this down. If you set aside $75 every week, that's $300 a month. And in 1 year, you're investing $3,900. Now, it might not feel like much at first, but over time, this small amount adds up. And the beauty of investing is that your money doesn't just sit there. It works for you. It grows, it reinvests, and before you know it, your portfolio is looking pretty healthy. The earlier you start, the easier it becomes. Plus, it's way easier than you think to work $75 into your budget. Just skip one fancy coffee a week or pack your lunch a couple of times and you're already on your way. Alright, now that we've got our $75 a week investment habit in place, it's time to talk about how to actually choose the right dividend stocks to build your portfolio. Picking the right stocks might sound complicated, but let's break it down and make it simple. First things first, dividends. Why are we focusing on dividend-paying stocks? It's simple. Cash flows. By the time you retire, you need consistent cash inflows for your monthly expenses. This means with dividend stocks, not only do you get the potential for the stock price to go up, but you also earn regular payouts. But again, there are thousands of options out there to choose from. I want to make this portfolio as passive as possible. For this, I will be choosing dividend ETFs, which are basically funds that combine some of the best dividend companies into one package. When choosing dividend ETFs, there are a few key things to keep in mind. To pick the right ETFs, start with dividend yield, how much the ETF pays annually as a percentage of its price. Avoid chasing sky-high yields, as they can signal instability. Instead, aim for sustainable yields around 2 to 4%. Next, focus on dividend growth. ETFs with rising payouts show their underlying companies are thriving. Reinvesting these dividends compounds your portfolio over time. Look for stability, meaning ETFs that include established, consistent, profitable companies. Check their track record to ensure they've delivered reliable results through various market conditions. Finally, ensure diversification by spreading your ETFs across sectors like consumer staples, healthcare, and U.S. equity, reducing risk if one sector underperforms. Think of dividend ETFs as your financial team. Some bring stability while others focus on growth, creating a balanced portfolio that generates income and long-term gains. The goal isn't flashy wins, it's reliable, proven funds that deliver steady value. In the end, I will show you how you can use this portfolio to turn a $75 a week investment into over $1 million portfolio, and even better, pay over $100,000 in annual dividends. Now, let's get a little specific. The ETFs I've chosen for this portfolio were selected based on these criteria. Each one is a carefully chosen piece of the puzzle, designed to give you a diversified and stable foundation while also offering strong dividend growth. Let's start with IYK, which focuses on consumer staples, companies that make products that we use every day, like food, beverages, and household items. This sector is known for being recession-resistant, meaning it holds steady even during economic downturns. It has a 2.50% dividend yield and a strong 10.47% average growth rate. Next is PEY, a high-yield dividend ETF, which has a 4.36% dividend yield. PEY is all about generating consistent income. While its growth rate is slightly lower, 8.75%, it's an excellent option for those looking to maximize cash flow in the early stages. Now, I have VHT, which gives you exposure to the healthcare sector, a long-term growth powerhouse. Healthcare companies like pharmaceuticals and biotech tend to perform well in both strong and weak economies, making this a defensive play. VHT offers a 1.42% dividend yield and an impressive 12.97% growth rate, making it perfect for adding growth potential to your portfolio. SCHD is the backbone of this portfolio. It focuses on high-quality U.S. companies with a history of stable, growing dividends. With a 3.38% dividend yield and an 11.13% dividend growth rate, SCHD strikes an excellent balance between income and growth, giving the portfolio the stability it needs to weather market ups and downs. Finally, I have DGRO, which focuses on companies that consistently grow their dividends. Its 2.14% yield may seem modest, but with an 18.34% growth rate, DGRO is a true long-term growth engine. It's ideal for reinvesting dividends and compounding your returns over time. Each of these ETFs have been chosen for a specific reason. IYK and PEY give you a stable income, while VHT, SCHD, and DGRO add the growth that'll turn your portfolio from decent to exceptional over time. By mixing high-yield ETFs with strong growth options, you get the best of both worlds, steady income now and the potential for your portfolio to really take off down the road. So now that we've got our ETFs selected and we're ready to start building, let's talk about what all this investment can look like in the future. Sure, it's easy to say that you're aiming for a $1 million portfolio, but what does that actually mean over time? Let's break down some numbers and look at how the portfolio might grow with a consistent investment of just $75 per week. First off, let's get the basics out of the way. With the ETF selected, our portfolio will have a dividend yield of 2.76%, backed by a strong dividend growth rate of 12.33%, and a respectable share price appreciation of about 7.50%. With a weekly contribution of $75 and an initial investment of $0, after year one, you'd have around a $3,900 balance acting as capital. After 10 years with compounding, your portfolio will be valued at about $65,838, with your total contribution accounting for $39,000. Give it 10 more years, and in 20 years, you will see your portfolio climb to $297,168. Meanwhile, your total invested amount stands at about $78,000. That's when the dividend returns become more noticeable, and reinvesting them back kicks in the compounding effect. And here's the big one. After 30 years, your portfolio will be worth over $1.4 million, $1,438,143 to be exact. Another big win here is the dividends you'll earn. After 30 years, you would be looking at about $131,569 in dividends alone, which adds up to a monthly income of about $10,964. All in all, over 30 years, you could see a total capital appreciation of $615,279. And thanks to reinvesting those dividends, you'll get an additional $705,863 added to your portfolio. Want to know how to turn a $7 daily investment into a $1 million portfolio that pays the same amount of monthly dividend income? Click the video on the screen to find out.